I am I am dressed in my tailored, boring, pale blue shirt today because I'm going to talk about accounting. I will try and make it as exciting as possible. Please listen anyway.
Welcome to your weekly dose of uncommon sense, helpful insights, and tough love. I'm your host, Tom Stimson. The Intentional Success Podcast comes to you through the generous support of Mertz Crew.
Mertz Crew helps top AV companies book quality AV freelancers. Your choice, your rates. We handle contracts, insurance, and payments. You save time, cost, and reduce risk. Start today at mertzcrew.com.
Now on to the show.
Hey folks, welcome back. All right, we're going to talk about accounting, which has always been one of my least favorite topics, except that I really do actually love talking about accounting because it makes accountants uncomfortable, and nothing makes me happier than sitting across from an uncomfortable accountant. So there's a couple of types of accounts out there, and I don't want to make this all uncomfortable. I want to make your bookkeepers, your CFOs, and your controllers uncomfortable. I don't want to make your admins uncomfortable. Your CPA is never going to be uncomfortable because they are never wrong. CPA's job is to keep you from going to jail because you didn't pay taxes. Have a great CPA, pay them very well, take their advice. I am not going to give you tax advice today. I'm going to give you business accounting advice, and take it to heart because this is one of those things that I actually know what I'm talking about. So pay attention, right? I look at a lot of financials. I look at them, I look at companies that want to sell. I look at companies that are being bought. I look at financials for people I'm advising, for change management projects. I've seen hundreds and hundreds of P&Ls and balance sheets from all sorts of companies of all shapes and sizes. And let me tell you, you would think that large companies have the tightest books, the most clearly understandable reports. Oh my God, no, they don't. I think the bigger the company, the fancier the bookkeeper, controller, accountant you have on the business, the more convoluted and useless accounting systems I actually encounter. And it's not that the information is wrong, it's not helpful, right? Accounting information should be helpful. Financial reporting should be helpful. Every report that you look at as a business owner or manager should have actionable data in it. It shouldn't have data in it that you need another report to tell you what the data means, right? So if I'm looking at a report that needs a report to explain the report, then I know I've got a problem that has to be fixed inside this organization. So what are the problems that we're trying to solve, right? That's where I always start. Why do I need to fix my accounting? Well, how many of you think you're a seasonal business and there's nothing you can do about it? Well, pay attention. I'm going to teach you how to fix at least 50% of the seasonality of your business through accounting, okay? How many of you know where your profit comes from, right? What's generating your profit? Is it your equipment? Is it your people? Is it the expenses? Is it this particular type of service or that? Do you know where your profit comes from? Most of you don't. We're going to fix that today. It's not hard. Okay? And third thing is, how many feel like you can't raise prices? Everybody struggles with raising prices. Well, guess what? It's an accounting problem because the same person that does really expensive things in your company is also doing really inexpensive things. And that's why you can't sell them at two different prices. So I'm going to help you address some of that as well. And this is where accounting is our friend. And I want your accounting, I want your financials to be your friend. And it means that we just have to make some very simple mindset shifts about how we set up our books. And yes, I am going to ask you to go back and fix your historic financials, at least back to the beginning of your current year. Now, before I moved on any further about telling you what you need to change in your financials, you do not need to go back and change them forever. And if any of you are running on the same accounting platform that you hate, nobody wants their accounting platform and you want to change it to another one, but you won't because you have all this data in the past, stop. Okay. You don't need to be on the same accounting platform to take historical data and marry it with current data. So cut the ties. If you need to move out of an accounting system, if you need to, do a hard cut and say that in 2025, we're going to keep our books differently, and we're going to have to go through some machinations to compare our income and revenue, our revenue and expenses and overhead to prior years, do it. Because in 2 years, it'll matter less. In 3 years, it won't matter at all. The sooner you do it, the sooner it won't ever matter again. And you'll also find out how important it was to begin with. Now, let's get the accounting fixed. Like, the number one thing you do, and this is going to be a short podcast because I know the attention span of accountants says we've got to get back to work. We've got data to push around. I'm picking on you guys. Sorry, I usually pick on salespeople. Look, in the business that you're looking at, it is probably, and I'm talking to the accountants right now, you're probably looking at a company that thinks it's doing the same thing it was doing 10 or even 20 years ago. They have equipment for rent. There's a rental inventory, and you're treating this as a rental company. Sometimes that equipment needs people to make it work. So we have labor income that goes out when the equipment income is there. And then we have expenses that we charge for people. And I still run into companies today who are just passing those expenses through because we can't charge, the client. We can't mark it up. We can't justify all of that because we're not really adding any value. We can't charge them more than what it costs us to do trucking because, oh my goodness, the sky would fall. We can't charge them more for the airline ticket than we paid for it. All right. You have those three basic categories in your system, no matter what you're calling them. And you may have a system where you're recording, revenue for lighting equipment differently than revenue for audio equipment or rigging equipment. And you may have all these revenue categories for equipment. And then you've got one big lump category for labor. All labor goes in the same category. All right. Pull back. Look at the business that you're running today. First and foremost, you're running a service company. Okay. And you do multiple services. If you are designing or planning events, if you're producing events, you do pre-production. That is a whole separate business from the one I just described, where we get a bunch of people and equipment, we throw it on a truck and we deliver it to a show site and do a show. Okay. Pre-production is a service. It happens at a different time from the show. It happens before the show. It may happen for months before a show. So separate all your pre-production services and any corresponding products. You might do content creation. You might have deliverables. Those need to be separated as well. Understand the different income streams. The labor that is doing pre-production and creating graphics and building animations and editing videos is not the same labor that you use on show site. It's completely different. It's a completely different service. Fix your revenue capture, right? So separate your pre-production services from your show execution services would be step one. And then within pre-production, you have creative, you have management, and you have execution, which is producing a deliverable piece of work, which might be a script, a video, a PowerPoint, whatever it might be. So separate those things. When they happen at different times, they should always be separated. Number two, recognize revenue and the expenses that go with them in the month that they occur. So if you're doing pre-production for a show in August and you're starting in January, you have 6 or 7 or 8 months of pre-production that has to be spread out. And some of you are writing your proposals much better. And I'm seeing, $800,000 shows with $350,000 of pre-production, which is about the right ratio. If you're doing content creative design, have an executive producer or producer team, that's not unreasonable. That's a huge amount of revenue to spread over those 6, 7, or 8 months. Now, you also have to put the corresponding expenses on there. So in the act of recognizing revenue when it is actually incurred, which is different from the revenue of actually doing the show, being on show site, which happens on a fixed set of dates sometime in August, all this other revenue now for all the jobs you're doing occurs in the month where the show isn't. So it's going to improve your revenue and it's going to flatten out. Some portion of your revenue, probably maybe as much as 20 or 25% of your revenue, is now going to spread out over 12 months instead of being packed in to the month that you occurred. So rather than artificially inflating the months where all the shows are, we're actually going to put that revenue when it happened. And it's going to reduce the appearance of seasonality in your revenue. Now, does it change the seasonality of your business? No, not really. But the fact of the matter is you're working on shows for weeks and months prior. Right? So is it really seasonal that you're busy because you have 5 shows in August instead of 2? No, a lot of that work occurred well before that. So we're going to separate pre-production and show execution revenues, and then we're going to recognize revenue and the corresponding expenses in the correct month, which brings me to item number 3 is you have to show a direct correlation between every income category that you have and the direct expense or the cost of goods sold related to it. Now, if I'm clever, if I have 12 income categories, I probably have 13 or 14 cost of goods sold categories. Now, what are the other 2? Don't worry, you'll figure it out. You have an accountant, they're very competent, right? Every income category has a corresponding cost. If it has no cost, great, put a line on there and put no cost on it, because then we can celebrate every month. Say, hey, we sold this for $10,000 and it cost us nothing. Wouldn't that be fun? But you have to see this direct correlation between income and direct expenses. Now, what else does it take to run your company? Overhead. If anything in your overhead is actually being used as a direct expense, you don't need to peel all of it out, but you need to peel the part of it out that is a direct expense. So if you have employees that are splitting their time between being part of the selling team, which is a below the line overhead expense, and being part of the delivery team or the production team or the creative team, okay? Or they happen to be your favorite video editor, they are also a direct expense and you need to account for them in there as well. Now, I don't think that that's a good distribution of how you use people, but in small companies, these things happen. We need to capture that. Oh my God, our employees would have to keep track of time. Okay. Oh my God. That's what every employee does in every company, in every industry, everywhere. Why shouldn't we do it in our business as well? I need to know what you're spending your time on. And if you can't tell me what you're spending your time on, you're doing too many of the wrong things. I guarantee you, people who can't record their time and tell you what they did this week are part of your problem. Great way to find out that you've got a silo issue with a hero employee who's got their fingers in too many pies, which is probably costing you a ton of money. So, is your accounting fit for purpose? It might be if you have clear understanding of all your revenue streams, you have a direct correlation to the costs for those revenue streams that lead to a gross profit, and you have no overhead that is mixed use with direct costs without being accounted for. Very simple business model. We're recognizing the revenue for services in the months and weeks that they occur, and we're recognizing the revenue and expenses for doing the event on the dates that the event happens. Matter of fact, the date the event closes, the final date, the end of show, the last day. If you load the truck on September 1, that is September revenue for that show, ladies and gentlemen. Or you can go back and prorate that show and create an accounting end of the month closing nightmare if you want. That is up to you. So revenue recognition does matter, but I'm mostly concerned about revenue recognition on the services that occur outside of the prescribed show dates. So we're going to address the apparent seasonality of your business with better accounting. We're going to understand where we make money. You're going to find out that your pre-production services are wildly profitable if you're running them correctly, right? And we're going to be more comfortable making profit on other things because we're going to find out how much cash is sucking out of our business when 10% of our revenue has zero profit, gross profit coming from it. That should make you want to throw up but you're not seeing it on your P&L. And you're going to feel very comfortable raising prices once you understand how it is you actually make money and where the value and price sensitivities of your customers truly are. Accountants can be your best friend. Get your books set up correctly, follow the right policies, run the business the way your business needs to run, but your accounting, your financials need to reflect that company so you can be better at it. Every report should be actionable. You can constantly make improvements. And once this is set up, you're going to have so much control and understanding of your business, you don't know why you didn't do it 100 years before. Go after it. Have fun with accounting. You'll thank me later. Thanks for listening, everybody.
If you liked this episode of the Intentional Success Podcast, please leave a review and don't forget to like and subscribe. This podcast has been brought to you by the helpful folks at Mertz Crew.